Hey, good day, everyone. Welcome to our webinar. My name is Bert Salazar, and I'm going to be your host. We're going to get started in a couple of minutes. Just waiting for more and more people to come in and log in. I can see that a bunch of you were waiting prior to the broadcast, so you're all logging in right now. I'll give it another minute or so because I don't want to take the time of those of you that logged in on time, so we're just going to give it about a minute and we'll get started at 9 a.m. I'm excited to be here with all of you today. I'm going to be sharing some great information that all of you are going to be able to utilize and maximize and take with you and implement. Because at the end of the day, I feel very strongly that information without education always leads to failure. And you can find information on the internet often. You can try to do research, but at the end of the day, if you don't have the knowledge background and the base and the foundation to make those financial decisions, then chances are you're not going to be doing as well as you would have had you had that knowledge background. So what we try to do here at Gables is to be able to provide you the education necessary for you to make the right decisions at the right time and for the right reasons. So I see that more and more of you are logging in. I'm going to give it another 30 seconds. So I'm excited. I have my water. By the way, those of you that are on the call, please go right ahead and turn off your cell phones. Just give this time allotted the opportunity for you to truly understand all the topics that we're going to be discussing. I'm going to go through some of the slides very quickly, but others I'm going to slow it down because those are going to be very critical ones that I'd like for you to understand and take with you. So that's how we're going to try to do it. We'll get this done in a very short time. I have scheduled a 1 hour for this webinar, but this is full of information. So believe me, if you're thinking about putting your retirement plans in order, if you're thinking about preparing for retirement, or if you're anywhere between 5 to 10 years away from retirement, or you may be already in retirement, then this is going to be a well worth 1 hour of your time, especially on a day like today, in order to make certain that you gather some good information that you're going to be able to take with you. Okay, I see more and more people are logging in at this point in time. Why don't we get started? Well, welcome everyone. I appreciate all of you being here with me today. Once again, my name is Bert Salazar, and I'm the managing member and partner for Gables Tax Planning Group, LLC, here in Coral Gables, Florida. I am going to be your host for this event this morning, and I'm excited to be here with all of you, and I appreciate all of you because I know all of you are very busy. You have other things that you could be doing, but because of the fact that this is so critical for you, then I do appreciate the fact that you're here. You know, one of the things that I try to do in my workshops, whenever we do them all throughout the United States, and I'll fill you in on that, is that I always try to make an analogy that there's a major difference between being involved and being committed. And the major differences between being involved and being committed, I can make an analogy as having a bacon and eggs for breakfast. The chicken was involved, but the pig was committed. So when it comes to your retirement planning, when it comes to your retirement distribution planning, being the pig and being fully committed is going to take you to a much higher level than if you're just involved and you're doing things little by little here and there when it comes from a retirement standpoint. Again, this is a webinar. I'm going to be recording this webinar and I'm going to be sending it to everyone because I had about 6 or 7 emails that were sent to me late yesterday afternoon telling me that some of you were not going to be able to attend. So I am going to record the webinar, and then I'm going to be sending it to all of you, including those of you that are already on this webinar today, because you may want to go back and listen to some of the topics that I'm going to be discussing with you today. Let me go ahead and share my screen with all of you, and you should be able to see my screen very, very soon. And I'm going to take you right to the presentation that I'm going to be using again today. For those of you that just joined us, Bert Salazar, I'm the managing member for Gables Tax Planning Group, LLC. Here in Coral Gables, Florida, I'm going to be your host today. And today's webinar is going to be a unique one. Last week I did a workshop, a retirement workshop at Florida International University, FIU, and I do one of those at the university every single month. And some of the questions that arose out of that, I decided to make a webinar today. And then obviously I sent an invitation to all of those that attended the workshop last week as well. So today's workshop is going to be to Roth or not to Roth. Tax is the question. At the end of the day, the major difference between traditional retirement plans and Roth retirement plans is where do you think that taxes are going to be in the future? So I'm going to give you a little bit of foundation. I'm going to give you a little bit of background. I'm also going to give you some, factual information regarding taxation and retirement. So that way you're going to be in a much, much better position to make the right decision at the right time, not only for yourself, but also for your family. Obviously, I need to use a disclaimer. Although I am a tax preparer and I run a tax planning firm, I am not employed by the IRS, so just relax, don't be afraid. And by the same token, I'm not employed by Social Security Administration because we are going to be discussing some of the critical aspects of Social Security benefits and their taxation from a business perspective. So again, it's important to use this disclaimer. One of the things that I'm very proud of is that I am a member of SOFA, as you can see here in my shirt. SOFA is the Society for Financial Awareness. It is a 501c3 nonprofit organization, one of the largest ones in the country, in dealing with financial illiteracy in the United States. Basically, our goal is to eliminate financial illiteracy throughout the United States, and we do so in a number of different ways. Most of the time, those of us that are members of SOFA throughout the U.S., we stay fairly busy because we get hired, we're brought in by companies, Fortune 500 companies, middle management companies, small businesses that have anywhere between 50 and 500 employees, and they want us to come in and provide financial education for their employees in all different topics and in all different subject matters. So, this is something that we do. The other thing that we do quite heavily throughout the U.S. is that we do these workshops and these financial literacy workshops at colleges and universities. For instance, in my case, I do it once a month at Florida International University here in Miami. And we do have a lot of attendees that come to those workshops because they want to prepare for retirement. So I'm very proud of that. These workshops are very, very strong in nature because A, they're free. Number two, I am not allowed to talk about any single company and or any single product. These workshops, and similar to this webinar that I'm doing for you today, it's for educational purposes only. And this is something that I'm very, very proud of because it's very important for me to give back to the community on an ongoing basis. Now, the goals that we're going to be discussing today are going to be very factual and very simple in nature. We're going to be understanding what the Tax Cuts and Jobs Act, which is the new tax law that all of us are living in today, what has been all those relevant changes that are so critical for us to understand. Number two, we're going to be understanding the impact of those changes when it comes to your retirement and your retirement distribution planning. Number three, I'm going to share with you some tools and strategies that are going to help you minimize your tax liability in retirement, and it's going to create an effective and very reliable retirement plan, not only for you, but also for your family as well. And then last but not least, I know some of you may want to get into political conversations. I'm not going to do that. We're going to stick to the relevant issues when it comes to taxation, retirement distribution, Social Security benefits, and the like. Thought of the day, and this is one that I've been using for quite some time, and this was given by a very famous president of the United States, and this was done over 40 years ago. And he basically said at that time that the problem with our tax system is not that Americans pay too little. The problem with our tax system is that our government spends too much. And the person who said that over 40 years ago was the 40th president of the United States, Ronald Reagan. By the way, that statement that he made over 40 years ago was as true then as it is today. You know, whatever government does, whenever a government starts to spend money, it's like, you know, they're just printing money left and right. So that's something that we need to address. We're going to look at that very closely in the next few minutes. And I think you're going to walk away with a very strong flavor as to what are some of the steps that you need to start taking right away in order to minimize your tax liability in retirement and for many years to come. Now, one of the promises that I'm going to make to you today is you're going to be able to walk away with an ability to be able to increase your retirement income while minimizing and or reducing your tax liabilities as well. And that's going to be very, very critical, because the more money that you can keep on your side of the ledger, the better off you're going to be when it comes to a successful retirement plan. Again, this webinar, excuse me, has two platforms. The first one is the one that I'm doing for you today, which is the educational part. And here I'm going to be providing all kinds of good, strong information and education to all of you. The second one is at the end of the webinar, if you feel that some of the topics that I'm going to be discussing with you today, you feel you want to take to the next level, you may want to get a hold of me and try to schedule a 30-minute conference call at no cost or obligation to you, just to address some of those issues from a personal nature, then you're going to have the ability to do so. But that's going to be entirely up to you. It's not going to be up to me. Now, as far as from my perspective, I'm a certified financial education instructor. I am very proud of that title because I take it wholeheartedly, because my goal is to provide education to all of you and to all of my clients over the past 30 years, which is something that I have been doing very, very successfully for a very long time. I'm not going to go much into my practice, but my practice is divided into three parts. We do tax planning, we do insurance planning, and then we do retirement planning as well. I would argue that 40% of our clients come through our tax planning side of the house. 40% of our clients come through our retirement side of the house. These are people like yourselves that are very much interested in retirement distribution. You're sitting here today gathering data, gathering information, acquiring knowledge, and then you may want to follow through with some of the topics that we've discussed. And then about 20% more or less comes through insurance auditing and so forth. But the vast majority of the clients that we engage on an annual basis come through our tax planning and our retirement sections in our business practice. I'm going to be sharing three major secrets with all of you, which is something very important for you to ponder and think about. Number one is I'm going to be able to share ideas where you're going to be able to have a much higher tax-free Social Security benefit. And also you're going to be able to reduce Medicare costs. Many people do not realize that your Medicare premium in retirement can really get fairly high unless you do proper tax planning. And this is one of the things that we do in our practice for the vast majority of our clients on an annual basis. Second secret I want to share with all of you is through a tactical retirement blueprint, you're going to be able to reduce your annual tax bill by thousands of dollars without having to take any type of risk, because at the end of the day, if you can reduce your tax liability, you don't have to take any type of risk in order to do that. And secret number three is even more critical, is that you're going to be able to protect yourself and your family from what I call the fatal four. And the fatal four are the four things that may very well happen to all of us in retirement that we need to make certain that we are protected against. Number one is the risk of living too long. People are living a lot longer today than ever before. And the one thing none of us want is to run out of money before you run out of life. So that's going to be very critical. The second one of the fatal four is the risk of living with a disability. The longer you live in retirement, the higher the susceptibility will be for suffering long-term care needs and illnesses and so forth. As a matter of fact, if you're a husband and wife and you're 65 years old and you're fairly healthy today, there's a 70% probability that one of you is going to have a need for long-term care at some point in time in the future, and the cost is going to be enormous. Number three is the risk of living with eroding factors. And the definition of an eroding factor is anything that can erode the value of your money in retirement. And what do I mean by that? Well, taxes, inflation, stock market volatility, interest rate volatility, your personal inflation or your standard of living inflation, propensity to consume, lawsuits, all of these things can have a negative impact on your retirement distribution planning. And then last but not least is the risk of dying too soon and the impact that that would have on your survivors when it comes to their retirement distribution planning if you happen to suffer a premature death, either prior to retirement or early on in retirement. So those are the three secrets that I wanted to share with you. The next thing that I want to share with you is something that I try to make analogies, because the more you understand analogies and how we relate them to retirement planning and retirement distribution planning, the better off we're going to be. And one of the questions that I ask in every single one of my workshops is, well, what is the goal of a mountain climber? 99% of the attendees to my workshops tell me that the goal of a mountain climber is to get to the top of the mountain. And although that is part of the goal, it is not the ultimate goal of a mountain climber. The goal of a mountain climber is not only to get to the top of the mountain, but to make it back down safely so they can tell the story to their families and friends. It's just like watching a football game. Nobody cares what the score is at halftime. The only score that counts is at the end of the game. So how do we relate that to retirement planning? Well, if you're climbing the mountain of retirement, then obviously you're going to have two sections. You're going to have the accumulation stage and you're going to have the distribution stage. The accumulation stage is while you're climbing the mountain. You're working, you're putting money away. In your IRAs, your 401ks, your 403bs, your pension, if you happen to be a lucky one. You may be making some investments, stocks, bonds, mutual funds. You may be purchasing some real estate in order to get a higher rate of return. So basically what you're trying to do there is put as much money as you possibly can, try to manage the volatility of the market, try to manage the volatility of those investments, and try to get as high a rate of return as you possibly can. So when you get to the summit of the mountain, which would be your retirement year, that you would have sufficient savings and investments that you can now live comfortably for the rest of your life. Now, once you get to the summit, you start to come down the mountain on the other side, which is the distribution side. And one of the things that I can share with all of you, and this is a mistake that the vast majority of Americans are making today, is that they're not able to make a paradigm shift between accumulation and distribution. And the reason why that is so important is that when it comes to distribution, the rules of engagement totally change because you're going from accumulation to distribution. In the distribution section of your life or portion of your life, it is no longer about the accumulation rate. It is strictly about the distribution rate, and to make certain that you make the right decisions so you don't run out of money before you run out of life. And this is something that we're going to be sharing today and that I'm going to be discussing with you, because it is very important to note that if you continue to do the same things that you did during your accumulation in your retirement distribution years, chances are you're going to fail miserably when it comes to your retirement distribution planning. Now, I took a picture of this a few months ago. By the way, this is closer now to 23 trillion. If you take a look at the top left-hand corner there, we're almost at $23 trillion in our national debt. And that's a major problem because that national debt continues to grow on an annual basis. Also, the other thing that is very critical is that, you know, the deficit between the money that we're bringing in on an annual basis, as you can see there a little bit to the right toward the middle at the top, we're bringing in north of $3 trillion in revenues into the U.S. government, but we're spending well north of $4 trillion. So for the first time in U.S. history in 2019, we're actually going to have a deficit of $1 trillion every single year moving forward, at least for the next 10 years. The reason why I mentioned this and the reason why I want to bring this and create a foundation for all of you is because all of the decisions that you're going to have to make in the future regarding whether to put money in a Roth IRA or not to put money in a Roth IRA or a 401k is going to be totally determined based on where you think taxes are going to be in the future. Now, if you think that is bad, almost 23 trillion in national debt and $1 trillion in debt in the deficit every single year, if you look at the very bottom toward the middle, notice that the unfunded liability for Social Security, Medicare, Medicaid, Medicare Part D, and interest on the national debt is now north of $124 trillion. Actually, it's about $126 trillion today, based on the fact that this is a snapshot that I took about 4 to 5 months ago. What is an unfunded liability? Well, pretty much these are all the promises that the government has made to all of us that they don't have the money to keep today. So the only way that the government is going to be able to offset this is to reduce benefits, increase taxes, do a combination of both. And this is something that's going to be very critical for all of us that are already preparing and or entering retirement. Now, one of the tax realities under the code that I want to share with you, and this goes back to Social Security Administration, is that the challenges are enormous. See, when Social Security was established back in 1935, the ratio of people that were working in the US at that time versus retirees, it was a 42-to-1 ratio, meaning that for every person that was retired in the US, there were 42 of us working. For those of you that may not know this, Social Security benefits is a pay-as-you-go system, meaning that the people that are employed today are paying for those that are already retired. Fast forward to today, the ratio has gone from 42-to-1 to 3-to-1. And the reason for that is that one of the largest generations in the history of the world has been the baby boom generation. I happen to be a baby boomer. Those of us that were born between 1946 and 1964 were actually retiring very rapidly and will be doing so for many years to come. There are 10,000 of us that are actually retiring every single day, and we will do so for many years to come. So the ratio has gone from 42-to-1 to 3-to-1. What is really sad about this exercise is that by 2026, the ratio is going to be 2-to-1. So we're having a major problem when it comes to funding Social Security benefits for those of us that are going to be retired or already retired from a governmental and benefits standpoint. Now, those of you that may not know who David Walker was, David Walker is probably the person that knows the most about fiscal policy in the US. He was the Comptroller General for the US government, and he was the head of the GAO, which is the Government Accountability Office, and he served under President Clinton and President Bush. He left the government in 2008, and he started to crisscross the country telling everyone that there was going to be a tax Armageddon coming, because at the end of the day, he basically said that based on current fiscal policy and economic policy that we have today in the government, future taxes would have to double or our country would go bankrupt. Now, pay attention to this. This is very critical. Unless something changes drastically, taxes are going to have to double or our country's going to go bankrupt. So just put that in the back of your mind, because that's going to be very critical when making those financial decisions. This is the history of the US tax rate. If you look at the bottom on the left-hand side, 1913, that was the very beginning of the IRS code. Taxes were very low there. If you notice, other than that period of time at the beginning in 1913, and then that small period during the Great Depression in the 1920s to 30s, we're actually living in the third lowest tax bracket in the history of our country. So we have historical high debt and historical low taxes. where do you think the taxes are going to be in the future? What are the things that you're going to have to do in order to control the tax liability and not allow the government to be able to control that for you? So that's something that you need to consider. The other issue that I get often from many of my clients, let me see if I can get some of this out of the way from you, is that, well, we can just raise taxes for the wealthy. And that's well and good. The challenge for that is there are not that many wealthy people to be able to pay all the taxes. So at the end of the day, poor people in the US don't pay taxes. So the vast majority of the taxes are going to be accrued and paid for by the middle class, those of you that are actually watching this webinar today. So don't let anyone tell you that you can tax the wealthy to the point that you're not gonna have to raise taxes on the middle class, because that is an impossibility. It is a math impossibility to be able to do that as well. Okay. All right, so this kind of froze on me real quick. Let me go ahead and do this again. There we go. All right, so what are the first principles of finance that I want to share with all of you today? Number one, everything that you finance, everything that you buy in this country, you finance. Either you pay interest to someone else or you fail to receive interest on your money by paying cash. So don't let anyone tell you that, you know, I pay cash all the time, I don't finance anything. Every time you use your money, there's a financing cost. Either you give up interest or you fail to receive interest on your money by paying cash. You either pay interest or you fail to receive interest on your money. The other thing is, when you're using debt, you're borrowing from your future earnings. And then obviously when you pay cash, you're borrowing from your past savings. So something very important for all of you to be able to understand from a business and economic perspective. By the way, this is an array of all the taxes that we pay in the US. You know, most of the time whenever I do accounting work for any of my clients, I say, well, what tax bracket you're in? And they'll tell me, well, Bert, I'm in the 30% tax bracket. And they fail to understand that that's only the federal income tax. They're not taking into consideration, you know, Social Security, Medicare, capital gains taxes, ordinary income taxes on investments, and everything else that you can see there for yourself. Now, let's start getting a little bit into the importance of understanding the difference between traditional retirement accounts and Roth accounts. And let's concentrate on traditional retirement accounts. And these accounts would be your traditional 401ks, your IRAs, your 403bs, and the like. First of all is make certain that you understand that taxes are not saved. You're only postponing the tax. I mean, when you postpone the tax, you're also going to be postponing the tax liability. So when your accountant says to you, you know, put money into a 401k because you're going to be saving on taxes today, run away from that person, because he or she does not know what they're talking about. You're not saving money on taxes. You're actually borrowing the tax that you should have paid today from the IRS, and you're deferring that tax. And when you defer the tax, you're also going to be deferring the tax liability, because you all know where taxes are going to be in the future. So if you delay that or you defer that tax liability to the future, there's a very high probability that your taxes are going to be much greater than they are today. Number two, qualified plans are controlled by the IRS code. That's something very important for all of you to understand. There are also distribution penalty rules, 59.5 and 70.5 rules. If you take money out of your IRAs or your 401ks prior to age 59.5, you are going to have to pay a 10% penalty. And if you don't take money out once you hit the age of 70.5, there's a 50% penalty, and we'll discuss that in the next few minutes, that you're going to have to deal with, plus taxes on those distributions as well. IRS is going to determine the liability upon distribution. So if you have money in a qualified plan like a traditional 401k or an IRA, and let's say you have $1 million portfolio, and you're going to retire in 5 years, you really have no idea what percentage of that portfolio belongs to you. Because always remember that what belongs to the IRS will always belong to the IRS. So not until you start taking distribution out of those accounts will you actually know what percentage of that distribution on an annual basis will actually belong to you, and it is based primarily on where taxes are going to be in the future from one year to the next. There are no deductions for investment losses. So for those of you that were investing in IRAs and 401ks in 2008, and all of a sudden your 401k became a 201k because you lost 50% of the money in the market, you could not take an investment loss on those investments because there was no cost basis to those investments while you make those contributions to those accounts at that point in time. Distributions are taxed as ordinary income, and that's a major problem because ordinary income are usually taxed at a much higher rate than capital gains. And distributions can actually impact, and this is a major takeaway, and we'll discuss that in the next few minutes, but distributions can actually impact the taxation of your Social Security benefits and or Medicare premiums and retire. I actually call it the torpedo tax, which is something that is coming under the water, and it's invisible. You can't see it, but when it hits you, it will destroy your retirement life and that of your family as well. What else can I share with you regarding understanding qualified plans? Well, the tax volume increases anywhere between 8 to 12 times during retirement, meaning that any tax savings that you incur in retirement today, you're going to pay to the IRS anywhere between 8 to 12 times more than all the savings that you incurred while you were putting that money away into retirement. I have an actual exercise here that I did for you. I did some math, and just to give you an idea, let's say that you were to put $6,000 away into an IRA and you happen to be in the 35% tax bracket. Basically what you have done is you have deferred, you have not saved, you have deferred $2,100 of taxes that you should have paid to the IRS for that year. The IRS is allowing you to borrow that money from them in order for you to defer that into your IRA account. Obviously, over a 30-year period, if you're doing $6,000 a year and your earnings are growing at a 7% gross, you would have a retirement $606,000 and change, and your tax savings of those $2,100 every single year for 30 years would equal $63,000 a year. So now you think you're sitting pretty, but now comes the distribution. Now comes the other side of the mountain. And you say, well, Bert, I'm going to start taking $50,000 out of the year, every single year out of the $600,000, and I'm going to start taking $50,000 in order to maintain my standard of living. If you stay at the same 35%, which most of us are going to stay either at the same rate that we are today or perhaps even a higher rate based on tax revenues and the fact that many of you and many of us, we're going to be losing some of those deductions that we were benefiting from while we were employed, or even our personal tax liability may be greater even if the tax rates remain the same. Then if we take $50,000 after paying taxes, we're going to be left with $32,500. So again, over a 30-year period of retirement, we would have paid the IRS north of $408,000 on $63,000 of tax savings that we thought that we had incurred when we were borrowing that money from the IRS in order to put it into an IRA account. So in reality, in this exercise, you actually paid the IRS 6.5 times more in taxes than all the savings that you incurred over a 30-year period. So you have to be very cognizant of that fact that there is, when it comes to qualified planning, there are no tax savings whatsoever. Lack of flexibility in distribution handcuffs. Obviously, there's only an 11-year window that you have flexibility between 59.5 and 70.5. Prior to that, you may pay penalties. After that, you may pay penalties as well. So there's only an 11-year freedom of flexibility and so forth. If you borrow funds through a 401k distribution prior to age 59.5, yeah, you can avoid the tax penalty, the tax penalty of 10%, but you have to pay the funds back within 5 years. And when you pay the money back into your 401k, you'll pay with after-tax dollars, and then when you take money out, you'll have to pay taxes on that all over again. So therefore, you may very well have a double taxation issue to deal with. The big question from all my clients is, well, Bert, am I now going to be in a lower tax bracket in retirement? And my answer is more than likely not. Unless you have been a financial failure for your entire life, there's a very high probability none of us are going to be in a lower tax bracket. The reason for that is simple. Number one, again, we're historical low tax rates and historical high debt. So taxes are going to have to go up in the future. And now we have an election coming up next year, and you can see all the political pundits, what it is that they're talking about. But most important, a lot of your deductions are going to go away, because when you're in retirement, either your mortgage is paid for, so you can no longer deduct a mortgage interest, or you've been paying mortgage for so many years that the vast majority of that mortgage payment nowadays is going toward principal, so it's going to reduce that deduction anyway. So on top of that, obviously your children, now they may still be living with you, hopefully not, but even if they are, you're not going to be able to take a deduction for them, so you're going to lose that deduction because your kids are not only a credit, but they're also a deduction. By the same token, because of the fact that you're now retired, you're no longer making contributions to your 401ks and your IRA, so you're not deducting that on that given year from an income tax standpoint. And then obviously you may not be contributing as much to your charities, because you may be giving more of your time in retirement as opposed to your money. So just by that mere fact, you may end up being a higher tax bracket in retirement, even if tax rate were to remain the same in the very future. Now, what are the tax-free sources of income that all of you need to pay a lot of attention to in this webinar? You have your Roth IRAs, you have your Roth 401ks, you have your municipal bonds, and you do have an asterisk there in municipal bonds, and I'll tell you what that is in the next few minutes. And then last but not least is 7702 plans, which are cash value life insurance plans that enjoy some of the greatest benefits under the IRS tax code. Some of my clients call 7702 plans Roth IRAs on steroids. And, you know, obviously I cannot do that, but the benefits that you get in a properly structured 7702 plan, you cannot get in any other type of product. But at the end of the day, it is not about products, it is about the efficiency of the process that is going to deliver success or failure when it comes to your retirement distribution planning. Now, when it comes to actual preferred tax sources, just see in this slide here that I have taken municipal bond funds away. And the reason for that is that although municipal bonds are exempt from federal income taxes, they actually have a negative impact on your Social Security benefits. The only three vehicles under the IRS code that will not have a negative impact on your Social Security benefits in retirement and will not have a negative impact on the Medicare premiums that you'll pay once you retire are your Roth IRAs, your Roth 401ks, and your 7702 plans. Let me repeat that again. Your Roth IRAs, your Roth 401ks, and your 7702 plans. Now, what are some of the things that I can tell you about Roth IRAs and Roth 401ks? Well, number one, the money grows on a tax-free basis. So once you put the money in, you put the money after tax, but the money grows tax-free for the rest of your life. Number two, you can distribute the money on a tax-free basis. Number three, there are limited contributions, just like you would have on traditional 401ks and IRAs. The same thing applies to a Roth 401k and Roth IRA. In 2019, the most that you can contribute to a 401k is $19,000. If you happen to be age 50 or older, you can do a $6,000 catch up for a total of $25,000. Those numbers change every year anyways. And for a IRA, the most that you can contribute is $6,000. And if you happen to be age 50 or older, you can do a catch up of an extra $1,000 for a total of $7,000. And that applies on both sides of the ledger, whether it is a Roth or whether it is a traditional IRA or 401k. There's no access to your funds prior to age 59 and a half. If you do have to have access to it, you can't always take your principal without any penalties because you already paid taxes on that money, but the growth will, you'll have to then obviously pay a penalty for that as well. There are no required minimum distribution. This is a big issue. because in traditional 401ks and IRAs, you have to take money out at age 70 and a half, whether you want or not, and whether you need the money or not. In a Roth account, you don't, except for a Roth 401k, but usually what we do is we convert those Roth 401ks prior to age 70 and a half in order to make certain that we can now control the distribution as opposed to the IRS doing all the controlling. No Social Security tax triggers, and this is a great thing about Roth accounts because they don't have a negative impact on your Social Security benefits, and their credit protection protected in the U.S. As far as municipal bond funds is concerned, the money grows obviously tax-free. You can take the money out tax-free as long as you do so in the residential state that you live in, where you purchased the bond and so forth. You do have access to your money prior to age 59 and a half, so you do have liquidity there. And there's no required minimum distribution similar to the Roth. So that makes it, from a liquid perspective, a good vehicle to have on your side of the ledger from a business standpoint. Now, it does have a negative impact on your Social Security taxation, so you have to be careful how much money you have in municipal bonds, but it's something that you need to consider whenever you do any type of tax planning from a business standpoint. There is no credit protection as far as municipal bonds are concerned, so if you get sued, obviously you can lose that money forever. And then 77, and last but not least, 7702 plans. I'll just give you some of the features and benefits. Number one, it comes with a tax-free death benefit because it is life insurance. So you have to understand that much. Number two is the money inside these contracts grow tax-free, tax-deferred. You actually can distribute the money on a tax-preferred basis and a tax-free basis if you do it the right way. You can actually transfer monies at death without any federal income taxes and or state taxes, as long as you do it the right way. So it does give you a lot of flexibility. You also have access to the money, just like in a municipal bond. You have actually access to the money prior to age 59 and a half, no taxes and no penalties. And similar to a municipal bond fund or a Roth IRA or a Roth 401k, there are no required minimum distributions, so you don't have to invade any of your investments out of a cash value 7702 plan at age 70 and a half, as you would be forced to do in traditional 401ks and IRAs. And what else can I tell you about them? Well, they're creditor protected in Florida. Every state is a little bit different, but in Florida, they're creditor protected. So it's a good thing for all of us that live in the state of Florida. It is self-completed in case of death or disability. So it does give you a lot of flexibility there in order to protect your family in case you don't make it to the promised land because you may suffer a premature death or a disability along the way. It does provide long-term care benefits. A lot of the new contracts, 7702 plans, have features and benefits that provide long-term care riders, so you can, where the insurer can actually access a death benefit in order to pay for the added cost of a long-term care need. So these are critical products to have in a retirement portfolio. You get obviously competitive rates of returns, whether they happen to be guaranteed or indexes or whatever it may be. And there are no Social Security tax triggers, another great benefit for 7702 plans, which are critical for all of us. And there are 30 different types of contractual uses that all of us can take a look at. And then obviously when it comes to putting together 7702 plan, if you have any questions, please feel free to reach out. I'll be more than happy to help you. Basically, the way that it works is that the insurance companies will determine the minimum premium. The IRS will determine the maximum, because at the end of the day, that investment that you make into those accounts, you get the money out tax-free. So you got to be, the IRS is going to control that. And then us at Gables Tax Planning Group and our clients, we determine the optimum amounts of contribution that we're going to make from one year to the next. Living too long is a big issue, and this is something that is very critical for all of us to understand, because Americans are living a lot longer today than ever before, and this is getting into why Roth IRAs and Roth 401ks are so important to all of you. If you're both alive at age 65, your husband and wife, and you're fairly healthy, there's a 50% chance of probability that one of you is going to be alive at age 85, and a 25% probability that one of you is going to be alive at age 92. And it could be not only if you're a husband and wife, if you're partners in life and you live together, the same application will apply. Income sustainment and retirement, sadly enough, 97% of Americans are going to run out of money before they run out of life, so it's important to understand that. Taxes and inflation are going to have an incredible negative impact on your distribution planning, and most retirees will only have Social Security benefits in retirement. Want to use a quick disclaimer as we are now approaching the end of this workshop, but it's getting to the part that is very critical for all of you to understand. These are not my parents, and they never used an Apple laptop, but that's exactly how they looked when they started to look at their retirement distribution planning. Obviously, they had a son that had an accounting background and a financial background, so I was able to help them successfully throughout their lifetime. This is how the tax brackets work in retirement today, something important for all of you to know. Also, you got to remember that the Tax Cuts and Jobs Act is going to sunset on December 31st, 2025, so we only have a 7-year window. You only have a 7-year window in order to do proper tax planning, and those are the tax brackets that you see there. Notice that today the tax bracket sits at 10, 12, 22, 24, 32, 35, and 37, and they were obviously at the 10, 15, 25, 28, 33, and 39.6. January 1, 2026, when we all wake up that day, taxes are going to go back to the old taxes where now the brackets are higher, but most important, your standard deductions are going to be lower now, will be lower than they are today. If you're married filing jointly in 2019, your standard deduction will be $24,400. If it goes back to the old law, it would be $12,200. So not only are your standard deductions lower, but now your tax brackets are going to be higher. That's going to have a negative impact on your retirement distribution planning. So you have a 7-year window in which to create a tax-free retirement life. And this is how the map looks. Obviously, you always want to make certain that we can protect our clients from going to the 12% to the 22% tax bracket, because it is a major jump, or from the 24% to the 32% tax bracket. And that's where tax planning comes into play along those lines. Now, capital gains, obviously, because of the fact that you're risking your money, the government is willing to say, look, if you're willing to invest into the U.S. economy, we're going to give you a tax rate that is going to be lower than traditional ordinary income taxes. So if all your income in 2019 comes from capital gains, up to $77,200 of that income, actually more than that when you factor in your standard deductions and credits and so forth, will be totally tax-free to you and your family. Once you go over $77,200, then you'll get into the 15% tax bracket. And then anything over $479,001 goes into the 20% tax bracket. So if you're going to have to pay taxes in the future, I would rather you pay capital gains taxes than traditional Social Security benefits, and that's then traditional ordinary income taxes, and that's how the tax map also works for capital gains. Now, there are 3 parts of the taxation that I handle for my clients on an ongoing basis, and obviously you have to look at deductions, exemptions, and credits. And to make it simple for all of you, think of it this way. Deductions and exemptions will reduce your taxable income. Credits reduce your tax liability, so it's important to note that. Now, one of the exemptions that went away during the Tax Cuts and Jobs Act is the taxation, the $4,050 that you would have gotten just for being alive. That went away because of the fact that the standard deduction almost doubled under the new tax law. So they needed to pay for it somewhere. Now let's talk a little bit about RMDs. For those of you that may not know this, required minimum distributions take place on all of your retirement accounts once you get to the age of 70 and a half. Therefore, if you turn 70 and a half in 2019, you are now required to take a minimum distribution out of your retirement accounts, whether they happen to be IRAs, 401ks, 403bs, pensions, whatever it may be. So at the end of the day, the way that the law reads is that you have to, if you turn 70 and a half in 2019, you're going to have to look back at all of these accounts that you had, all of these retirement accounts as of December 31st of 2018, take those values and use a formula in order to determine what percentage of those values you're going to have to take, whether you want to or not, or need or not, from a retirement standpoint. So let me give you an exercise. Let's say that at the end of 2018, you have $500,000 in IRAs or 401ks. Now you have to use a formula that is given to you by the IRS, and this rate at age 70 and a half, it would be, the ratio would be 27.4. So you divide $500,000 into 27.4, and now the formula tells you that you must take $18,248 as a required minimum distributions for 2019. Now you can always take more, but if you take less, then obviously you're going to have a major problem in your hand. Now, another question that I get often is, well, Bert, do I have the ability to delay that distribution? And the IRS says yes, absolutely. For the first year and the first year only, again, if you turn 70 and a half in 2019, you have a choice. You can either take the distribution by the end of 2019, or you can delay that distribution to April 1st of 2020. And then the question comes, well, does it make more sense for me to delay it and take it this year? The answer is, it depends. It depends on what your tax liability is going to be today in 2019 versus 2020. And that's where tax planning comes into play. And the reason why it's important is that if you delay taking that distribution until 2020, now you have to take the 2019 distribution by April 1st of 2020. But on top of that, you're going to have to take the 2020 distribution by December 31st of 2020. So therefore, if you delay the 2019 distribution, you'll have to take two distributions in 2020. Now, if you had more income in 2019, perhaps that makes sense, but many times it may not make sense for many of you. What are some of the issues to concern also regarding required minimum distributions? What would happen if in your retirement accounts at the end of 2018, you had a 401k and you have an IRA? Can you consolidate the distribution between the two and take one distribution from one account? And the answer is no. If you have a 401k and you have an IRA, you have to take the required minimum distribution based on the balance of the 401k at the end of 2018 and also the balance of the IRA at the end of 2018. You cannot commingle the distribution out of those funds. Another question would be, well, Bert, what if I don't have a 401k, but I have, let's say, $100,000 in 4 IRAs, and I have them in CDs at 4 different banks? Under the IRS code, because IRAs are like-kind accounts, the IRS does allow you to commingle and take one distribution that would suffice for all the IRAs that you have out of one account. So if you have IRA A, B, C, and D, and you have to take $10,000 in distribution total, and you want to take it out of IRA A or B, or A and B, and not take it from C and D, the IRS will allow you to do that, and you would not have any penalties from a taxable standpoint. The final point, because I can spend an hour just talking about RMDs, because there are a lot of issues and concerns and things that you have to critically understand. The final thing is that if you fail to take your required minimum distribution, which in this case is $18,248 at the age of 70 and a half on a $500,000 portfolio, please bear in mind that there's a 50% excise tax penalty that you're going to have to pay to the IRS, in addition to the taxes for the amount of money that you should have paid, the $18,248 that you failed to take. And by the way, when you do that every single year, you're going to have to go back to the uniform lifetime ratio and table, which I do every year for my client. Now, your financial institution is going to be sending you what your required minimum distribution will be out of each account that you may have in retirement. The challenge is, you know, how do you commingle them? You know, does it make more sense for you to take it from one versus the other, and so forth? And this is how the table looks, and that's something that you can actually go on the internet and pull for yourself and have it readily available. Now, let's talk a little bit about Social Security taxes and the importance of having Roth IRAs, Roth 401ks, and 7702 plans. Every year when I do tax planning for my clients, I have to do something that is called a provisional income calculation. And this is to determine, once my clients start taking Social Security benefits, it determines what percentage of their Social Security benefits will be taxed in retirement. The way that I handle those calculations for my clients, we need to take 50% of the Social Security benefit that is paid for the year. To that, we have to add all the ordinary income that they received for that year. Part-time work, full-time work, distributions out of their IRAs and 401ks. So that's why it is very critical to understand how much you need to keep in those accounts in order to not create a taxable liability for you and your family. To that, we're going to have to add dividends and capital gains from any stocks, any sale of real estate properties in which you're cashing out the distribution and so forth. You're going to have to do that from a business standpoint. And then last but not least, you're going to have to add the non-taxable interest, which are those municipal bond funds that I put an asterisk a little while ago, because although municipal bond funds are received on a federal income tax benefit purpose, they do have a negative impact on your Social Security benefits because they have to be added to the calculation. And then after we do all this calculations, if you happen to be single, your income after all the calculations are done and the deductions and exemptions are under $25,000, then you pay no federal income taxes on your Social Security benefits. If they're between $25,000 and $34,000, up to 50% of your Social Security benefits may be taxed in retirement. And anything over $34,000, up to 85% of your Social Security benefits will be taxable. Well, what if you're married filing jointly? Well, if it's under $34,000, then you pay no taxes on your Social Security benefits. Between $34,000 and $44,000, up to 50% of your benefits will be dragged into the tax table. And then anything over $44,000, up to 85% of your Social Security benefits will be taxed in retirement from a business standpoint. It is important to understand your taxable and your tax buckets in retirement, and there are three of them. You know, the IRS code has over 77,000 pages, but I want to keep it simple for all of you. So there are three major tax buckets in the code. You have your taxable bucket, tax deferred bucket, and tax-free bucket. Taxable bucket, your savings, CDs, mutual funds, you get a 1099-A every year from the financial institution, and you have to pay taxes on that. Your tax deferred bucket is what we've been talking about. This is your 401ks, IRAs, 403bs that are traditional in nature. You put the money in pre-tax, the money grows tax deferred, and then when you pull the money out, you have to pay taxes on the whole thing. So you have to have limitations on how much money you're going to have in your tax deferred bucket, because they're going to have a negative impact on your Social Security benefits and also on the Medicare premium that you pay every year. So you got to be extremely careful as to how much money you have there. And then last but not least, you have your tax-free bucket. Includes your Roth IRAs, 401ks, 7702 plans, and those municipal bonds, but also with an asterisk, because you have to be careful with municipal bonds because they'll have a negative impact on your Social Security benefits. So the key is to maintain the right balance between the taxable, tax deferred, and tax-free bucket. And we don't have the time to have this conversation. Now, let me get toward the end of this workshop today. And I'm now going to share a sample exercise on how it is that you can actually start putting some of the things that I've talked to you about today into practice in order to reduce your tax liability. Now, bear in mind, You need to be able to talk to someone that is an accountant that understands provisional income, that has a software to be able to help you with all of these issues and concerns, and to be able to determine, how to maximize your tax benefits. One of the major advantages that those of you that have right now traditional IRAs and 401ks in retirement is that over the next 7 years, you're going to have the ability to do annual conversions, meaning that you have the ability to start taking money out of your traditional IRAs and 401ks and convert them to a Roth IRA in order to avoid the higher taxes in the future. Now, obviously, in order for you to get into the tax-free bucket, you have to purchase a ticket and you have to be able to pay the taxes today. But whenever I do these tax planning calculations for my clients, and for those of you that attend these webinars and workshops that I do on a monthly basis, and I do this, by the way, at no cost or obligation to any of you, you have to understand what your tax liability is going to be in 2019, 2021, 2022, and so forth, to determine what is the optimum amount that needs to be converted from a traditional IRA or 401k to a Roth. So without any further ado, let me take you right to an exercise, because one of the things I think it's important for all of you to understand is when you're coming down the mountain on the other side, the one thing you can remember about retirement is that not all income is created equal. So in this exercise, we have a client that is retired now. And he or she, they're actually taking $50,000 in IRA distribution. Let me share with you, let me go ahead and annotate so you can actually see my cursor as I walk you through this. There you go. So it's $50,000 of IRA distributions. And when they're taking $50,000 of IRA distributions from their retirement accounts, notice that in this case, $50,000 of IRA distribution has a tax liability of $2,430 and an effective tax rate of 4.86. Now, although the $50,000 of IRA distribution places them in the 12% marginal tax bracket, their effective tax rate is only 4.86. So when these clients came into my office, I said, you know what, Bert, it makes a lot of sense for us to take $50,000 out of our IRA account, because if we're able to do that, then I'm only going to pay $2,430 in taxes, and I'll do that any day of the week. So I said, look, what if I can improve on that situation? And said, really, you think you can improve on that? I said, well, let's give it a try. So basically what I did at that point in time, I said, look, what if we're able to split the 50,000? What if instead of taking 50,000 out of your IRA, what if we take 35,000 of Social Security benefits that you wanted to delay because you wanted that money to grow, but from a taxable standpoint, it may not make any sense. And then obviously now we only need 15,000 out of your IRA distributions in order to hit the $50,000 mark that you need. And when we do that, take a look at what happens. In the first scenario, that we're pulling $50,000 out of their IRA, paying $2,430 in taxes. In this scenario, by taking $35,000 out of Social Security benefits and $15,000 out of their IRA, they're still enjoying $50,000 of income in retirement, but now their tax liability is zero. So the point that I'm trying to make here is that in retirement, not all income is created equal. So, and other things that I said to the client, look, if you're in this situation, now you're able to pull $15,000 out of your IRA and pay no federal income tax. So that's actually the best of all worlds, because remember, you put the money into the IRA pre-tax, the money grew tax deferred. And then when you pull the money out, you were supposed to pay taxes, but now because of the fact that you've done proper tax planning, you pay no taxes on distribution. That's the best of all worlds. So what if we can pull some more? How much more can we pull out of this IRA account without having to pay a single federal income tax? And in this case, we actually added another $7,000 of distribution. So we're actually pulling 22,000 IRAs. So we're pulling in an extra $7,000 of income. So we went from 50,000 of income, paying $2,430 in taxes, to receiving $57,000 of income and paying no taxes whatsoever. This is what tax planning is all about. What can you do with an extra $7,000? Well, the client may say, you know what, Bert, I don't need the extra $7,000. But my question is, well, wait a minute. If you're not going to pay taxes on it, why not take it out anyways? If you don't need it, then convert it to a Roth IRA, and now the money grows tax-free for the rest of your life. So there are a lot of things that you can do along those lines from a business perspective. Then the next exercise that I walked the client through, I said, look, when you walked into my office, both you and your wife felt that, you know, the $50,000 of IRA distribution, paying $2,430 of taxes at a 4.86% effective tax rate was a no-brainer to the two of you. And now I have shown you how I'm able to take more money than you would have taken without having to pay any taxes whatsoever. But you know, what if you're okay paying the $2,430? How much more money can we take out of your retirement account to meet those $2,430? And when I did the exercise, I was able to pull $36,000 out of their IRAs for a total of $71,000 of income. So in reality, we had an extra $21,000 of additional income and a net amount of $20,994 after taxes. And we ended up paying $2,436. So I went over by $6, but think of it this way. Now the client pay the same $2,436 or $2,430 that they would have paid on $50,000 of IRA distribution. Now they're able to take those $21,000 or the $20,994 that remains, and they can take a portion for a vacation. They can, you know, gift it to their grandchildren, and they can take the entire amount or split it and put into a Roth IRA and have that money grow tax-free for the rest of their lives, while they can enjoy now the total control of those distributions. So why not do it from a business perspective? What if you happen to have $50,000 in long-term capital gains? Well, if you have $50,000 in long-term capital gains, and your tax liability is zero. So again, remember, when it comes to retirement distribution planning, not all income is created equal. So this is something very, very important for you to understand. And for those of you that are 5 to 10 years away from retirement, now is when you need to start doing the proper tax planning under the new tax law to avoid having to pay those higher taxes in the future. And then obviously, what if you have $50,000 in long-term capital gains and you also want to pull $50,000 of IRA? So now you have a total of $100,000 of income. Guess what? You're paying $2,430 in taxes, which is the same amount of taxes you would have paid on $50,000 of IRA distribution, but now you have $100,000 of income from a business standpoint. To finalize this webinar and workshop for all of you, there are 4 major questions that most financial advisors and most accountants and most tax preparers fail to ask their clients as they are preparing for retirement. And unless you have the ability to answer these questions from an economic perspective, then chances are you haven't done any type of retirement planning and or tax planning whatsoever. Question number 1, what specific plans have you made to triple your income during retirement? And the reason why I say triple your income in retirement is because all the income that you're going to need in retirement, you haven't earned it yet. So your retirement accounts are going to have to multiply themselves in order to keep you in retirement for many, many years, because at the end of the day, you know, retirement is divided into 3 parts: the go-go years, the slow-go years, and the no-go years. So you want to make certain that you don't run out of money before you run out of life. So your assets are going to have to triple. Otherwise, you're going to be in deep, deep retirement trouble. Question number 2, what would happen to your financial situation today, especially those of you that are either in retirement or 5 years to 10 years away from retirement? What would happen to your financial situation if the stock market dropped 45%, as it did in 2003 and 2008? What would happen to your financial situation today? And if you cannot answer that accurately, then you don't have a retirement plan in place. Question number 3, What have you done as a family to protect your retirement assets from stock market volatility and interest rate volatility? The what ifs of life. What if the market drops 30, 40%? And what if we have another war? What if we enter into a trade war with China? We are not able to reach an agreement. What if we have the president of the United States impeached? What if we have another 9/11? What if we have an economic meltdown, or we have a depression or a recession? You know, what have you done to protect your retirement assets? Because you're running out of time from that perspective. And then the last question is, what plans have you and your family made in dealing with the rising cost of healthcare and Alzheimer's? Because one of the major problems that the vast majority of us are going to have to deal with in the future is that because of the fact that we're living a lot longer than we have ever done in the history of the world, we're also a lot more susceptible to long-term care needs. And most Americans are going to have a need for long-term care. So what have you done in order to protect your assets, in order to multiply and have a multiplier effect to your assets, in order to maximize the protection of those assets against the rising cost of healthcare, and also protecting yourself and your family from the issues of long-term care in the future? Obviously, the call to action is simple. The definition of insanity is doing the same thing over and over again, expecting a different result. So if you want to change the way you're doing things today, just stop rearranging the chairs on the Titanic, because whenever I do an audit for a new client that comes to see us, basically what they have been doing for the last 10, 15, 20 years is rearranging the chairs on the Titanic after it hit the iceberg. So they continue to do the same things that got them into the situation that they are today from a taxable and retirement standpoint. Number two, if you're interested in putting together a tactical retirement blueprint at no cost or obligation, then go ahead, schedule a 30-minute call with me. You can actually reach out to me. You can call me at area code 786-766-1042. Again, Bert Salazar, and I am the host for this workshop today. You can also send me an email at Bert, B-E-R-T, at GablesTaxGroup.com. And you can also obviously visit our website at www.gablestpg.com. Let me just leave it for an extra 30 seconds. If you want to take a picture with your phone of that information and reach out to me, feel free to do so. But once again, I want to thank you for the time that we have spent together this morning. I am certain that this has been viable time, that you have been able to gather a lot of information and education that otherwise you would have never been able to do. For those of you that are looking at your retirement map today, and now you start to see that there are some holes that need to be plugged and that there's some tax planning to be done, remember, you only have a 7-year window in which to maximize your tax planning, because when we all wake up January 1, 2026, taxes are going to be higher and your standard deduction are going to be lower, and more than likely taxes are going to be a lot higher than what you saw in that tax slide that I share with you. So again, once again, always remember that my goal and that of my firm is to kind of help each and every one of you change the way that you see things. Because when you change the way that you see things, the things that you see change. So once again, thank you for your time today, and I'll talk to you soon. Take care. Bye-bye.